This is Smart Investing with Mike.wren.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Wren. With Michael's producer, Chris Martin. You can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike.wren.
Well, hello again, everybody. You have downloaded or pressed play on another episode of the Smart Investing Show, where this is the show where we try to take the topic of investing. Number one, we try to make it easier to understand. Number two, try to get you good, relevant information on each and every show. Third, we try to be entertaining. The entertaining portion, that's Chris. He's the producer on the other side of the table with all the buttons and stuff like that. Hello again, dear sir.
Hey, how you doing?
Chris, we are doing these two smaller shows back to back. Most people will get them a week apart. We're doing them mere minutes apart.
It's been a whirlwind week, I've got to tell you, since the part one of the last podcast. It's been insane.
Yeah, since part.
It's been insane.
Literally, it's gone by in just minutes.
I bought some shoes from a drug dealer.
How do you know?
Well, I don't know what he laced them with, but I was tripping all day.
And there go the phones. Yeah.
No, there's a website called Cameo where you can pay people, like internet people and hire celebrities to like do a shout out or something. And some people charge $100, $150, $75 to say hi. I charge $1. Because if you have internet in front of your word celebrity, you should not charge more than $1. So I do dollar dad advice, and some guy gave me $1 to come up with 10 dad jokes for his friend. So
really,
I've been walking around doing dad jokes all day.
Did you come up with all 10?
I came up with 10. My youngest daughter, won't speak to me now because she's done with them. So we called her up for dinner. She said she's not coming up unless I promise not to say any more dad jokes.
Okay, well that's okay.
There's a restaurant on the moon.
What?
Yeah, it's got good food, but just no atmosphere.
Okay, George Jetson. Jesus, people. We have created a monster here. So, the last show that we just did, I was talking about the anxiety-producing scenario that happens when somebody starts to look and think about their retirement, not working anymore, working a lot less, wondering where they're going to get income from. They typically, the people that have an easier time with retirement, we'll just call it that, they typically have bigger guaranteed payouts. They have, or they've paid off everything to where their Social Security pays for most of what they want, and then they've got another retirement or a pension coming from maybe a company or something. I will admit that those folks that have more guarantees coming in typically are happier, and they can deal with the volatility of the investments that they have with me a lot better. And then they become really comfortable after a few years goes by when they realize that the volatility doesn't mean very much. But you have to get to the point where that volatility doesn't mean very much. And for most folks out there, they're nowhere close to that. Like I said in the last show, you start thinking about income. Where does that come from? You grab your statement, then you start grabbing several statements to see what your principal has done. None of that is constructive or gives you an idea of the type of level of income that you want or could get or any of that. And you just go down this rabbit hole of bad emotions, and then you find yourself looking at stated interest rates off of investment products, different services out there, different insurance products, or fixed income bonds, and I don't know if you're happy with those or not. I know that I wouldn't be, but maybe you are. And like we said in the last show too, it's okay if you don't want to approach investing like I do. Then really don't call it investing in my point. You can call it investing, I guess, because in the end game, when you take these products apart that everybody wants to sell, they have investments inside them, but it's very far removed from the very, very basics, typically. And it really, really muddies the water. So I think it's very, very constructive if a person, an investor, can say, truly, I don't know if I'll ever be okay with the volatility. That's good. Then we know. And then somebody like me has to be, forthright enough with you to tell you, okay, well then if you're not comfortable with volatility, that's really going to take a haircut off your performance. But that might not be the worst thing in the world, because you might be, like Chris said in the last show, you might be tired of worrying about money or thinking about it. You just don't want to have to think anymore. That's got a value to it. I guess I'm just open to that. I am an equity zealot, but I realize that I'm an equity zealot, and I realize that what I'm a zealot about is only applicable to a small part of the population. I have a feeling that if people were actually instructed and taught about what true investing is, and taught about getting, how to come to grips with their emotions, how to not think that volatility is so darn, important, so it's so meaningful, I think a lot more people would be a lot more successful investors. But letting them be investors and then giving them a whole bunch of stuff that they can invest or buy in is kind of getting the cart before the horse. So on this show, how do I think of investing? A little bit of a review. Like I said, you're looking at your principal. Then all of a sudden you start thinking of, oh gosh, I don't like it going down. And then it goes up. I was happy then, but if it goes up, now I know that it goes down. Then you start thinking, I don't want any volatility at all. And then you start looking at a stated interest rate, and it's like, slow down there, Buppy. Let's back up. Let's back up. It's almost spring. It doesn't look like it outside, but it's almost spring. Let's go through some spring training like the professional baseball players. It's pretty applicable because baseball is incredibly hard, but in its simplest parts, it's catching the ball, throwing the ball, hitting the ball. And these professional athletes will tell you that hitting the ball, they all start from a pretty low square one in spring training. Their timing is off. They're another year older. Maybe their vision has slightly changed. Maybe their perception of the ball has slightly changed. They have to relearn hitting techniques every single year. And even when they do that, they only hit 30% of the time. And if they can hit 30% of the time, they earn hundreds of millions of dollars. Okay? Luckily, what we are going to try to do isn't as hard as that. But it is pretty instructive to have some spring training. Now, I have said before on other shows and podcasts that I think that there are only 3 true investments. Investing in your own business, investing in somebody else's business, or owning some real estate. That's it. Because those 3 things should make your principal investment go up, and they should be able to spin off some cash flow. In other words, called a dividend. If it's real estate, it's probably called rental income. Okay? So when you buy a piece of real estate as an investment and you have somebody else using it, leasing it or renting it, they're paying you the rent and you're getting that money. And over time, hopefully the value of whatever you purchased actually goes up as well. So you are getting 2 positive things happening. Okay? It's the same thing when you own your own company. If you own your own business, you are making profits every single year. And if you're not in business very long. So it doesn't exist. So if you're making profits, you're probably taking somewhat of a portion of those profits out to live on, because you need to live. And those portions of the profits that you are taking to live on, when it's your own business, I guess you would say it's a dividend that you're paying yourself. And if you own somebody else's company, which is owning common stock in a publicly traded company, when that company pays you a dividend, there you go. That's cash flow from the profits. And hopefully over time, if you've owned that 7-Eleven or the cleaners, hopefully over time, that business over 5-10 years actually grows in value as well, becomes more valuable. You get better at running the business, maybe more customers, maybe profit margins go up because you've paid off some debt, paid for some equipment, things like that. Same thing when you own when you own a common stock, you own a piece of that company, whether it's a McDonald's, a Starbucks, a bank, a drug company, and hopefully over time, that those managers that run the company, they can be more profitable over time. That's true investing. And you probably might be thinking, well, Mike, I think I know where you're going with the income for retirement, but it sure doesn't feel like it yet. You're right, because most people don't think about that. But you probably know the people that own their own business, and they are thinking more about who takes over the business when they don't want to work there so much anymore, and then they do a few calculations of how much they can take out of the business per year, and then it's done. They're kind of done thinking about it. They're revisiting it. They're checking of who's buying the business from them. They're making sure that maybe that they're running it okay. Maybe that person that bought it from them is asking for a little bit of advice. Maybe they're not. They're definitely keeping some attention to it, because what do they want? They want that income. Have you noticed that they're concentrating then on the dividend that they're getting from that business that they own? They're not necessarily concentrating on what the business is worth in its entirety, because it's really not germane to them getting income. They're getting payments for this business over time. They've settled on a price and so on. And so now they're getting maybe a portion of the profits and a principal payment from somebody that's buying it from them. Maybe somebody gave them a lump sum, and they don't have that. But you see how it's that way of thinking. When you're thinking that way, there's more stuff to think about. So there's less time for your brain to jump in on something that produces anxiety. Okay? So you know that one of the tricks that maybe to try to be not nervous is you try to think about other things, because your brain can only think about one thing at one time. It's not as effective as meditation, but it's like 1,000,000 times easier. So it's what I've done most of my life. If I'm stressed out, I typically will try to go for a bike ride or work in the garage on something that my brain is immersed in something, and it's immersed in it so much that I can't be thinking about what I'm nervous about. All of a sudden, I'm not nervous anymore. Ha, ha, ha. Well, unfortunately, I've been engaging the nervous system in my body that raises my heart rate instead of lowers it, but it still feels better. I'm just like all of you out there. I'm not a person that's going to get on my yoga mat and meditate, even though I'd probably be healthier. So at least I know that. What are you laughing so much about?
I just picture you laying on a yoga mat with curse words just flowing out.
It's a different form of yoga. So that's where we start. We start with true investments. And what's nice is that what people concentrate on when they own true investments, unless it's real estate, if you're owning, and if they own their own business, they don't even concentrate on it. Typically what happens is when people own the common stock of other businesses, they concentrate on the principal going up and down. They don't look at the dividends being paid. They don't look at the dividends that have been paid in the past, and they don't look at what they are currently. They kind of don't even look at them at all. They're looking at their principal going up and down, trying to figure out what the hell to do. And there's a more instructive way to go about this. The way that I approach retirement is obviously most of the time I'm telling people, be okay with the volatility. We're going to own these individual companies. These individual companies pay dividends. And by the way, they're profitable enough that the vast majority of these companies have increased their dividends yearly for a substantial period of time. We're talking multiple years, most of the time multiple decades. And when I'm talking to people like this, whether they're current clients, whether they're a prospect that's come in, a referral from some other client, here's what I see. I see in most people's eyes, nonverbal communication, sometimes their words. I see, and I see this with Chris too, I see a portion of time where they are listening and engaged, and then all of a sudden, their body language changes, their words change, their gaze changes. They're not there anymore.
I've been married a long time. I know. And that. What is she saying now?
Yeah, they're thinking about how they feel. When I was talking the last show, or maybe this show, I forget which, that client where she had worked her whole life, sometimes 2 jobs, since she was 18. And now she's going to be retiring. She's been a client for a while. They like me, okay? And I'm telling her the scenario, and I can see her ebb and flow. Sometimes she's with me. Sometimes she's fighting the anxiety feelings inside her mind. Sometimes she's with me cognitively, like, oh, there's where the dividends are from. And sometimes she's reverting back to the emotions. I can see it happening. We've all, maybe if we're parents, we've all seen it before where you're trying to calm a child down and they're listening to you for a moment and then they're reverting back to the fear for a moment and then they're listening to you you've seen that, haven't you, Chris?
Yeah.
It's normal.
And my thought was, there's key words that you're coming up with, like when you when you say, you'll have this much in the future. And then you keep talking, but they hear that word future, and they're like, okay, where am I going to be in like 5 years or whatever? And so they drift off, and then they got to come back and listen.
Or then they'll think about, what about the next time the market goes down? What about that happens in the next election? It's, if you think about, let's say you're a kid, and everybody, I think, had a fear of something. A lot of people, it's the doctor. With me, it's needles. Some people, it's the dentist. There's a lot of things that happen that cause your brain to fly out of control, your emotions to fly out of control. And when you're in a grown-up, you're typically not crying and asking for your mom and dad to hold you, but those emotions are still there. You have learned to hide them. You've learned to not show them or not show them as much. But when I'm talking to somebody about money that's so integral to their life, I can see clients and everybody come and go in the conversation, the ebb and flow. I can tell when they are going to their emotional, scary places, and I can tell when they're back with me. And the more emotional the person is, the more that happens. The shorter the time that they're with me, the shorter the time they're anxious. They're going back really, really fast. Folks that tend to be more calm and okay with things, they can be with me a much longer period of time. And then a lot of times they may sit back after I'm done speaking a few moments. They sit back in their chair and they start to ponder things, and then boom, you can tell. Then they'll come up with some sort of an emotional question. Well, what happens if this happens? Sometimes it's not an emotional one. When they're asking me a question, I'm thinking, here comes an emotional thing. And it's not. It's something like nuts and bolts. It's like, what happens if we're traveling? How do we get our income then? That's obviously not emotional based. They're just thinking of nuts and bolts. And I can see that happening. And I don't know how many of my competitors spend enough time with somebody or actually care or are attentive enough to see the human mind working that way with the emotions. So I see that happening. And when I'm seeing that happening, I'm trying to talk as little as possible, because I know that it's better. Me talking less is better. Me seeing the person think and getting questions from them, that's where the hallmark is. That's where the rubber meets the road, so to speak. So people are wondering, well, where does the income come from? Where does the income? What's my stated interest rate? And I try to go through that scenario, like dividends when you own your business or if you own somebody else's business. Well, again, I've talked about it on several shows. Let's talk about the dividends instead of the price per share. Let's talk about the dividends of companies. I'm looking at a sheet right now. You've got Qualcomm, their current dividend is over 4%. We've got Verizon, their dividend is over 4%. You've got Boeing, their dividend is under 2%. Abbott Labs, it's under 2%. You've got Bristol Myers. You've heard of that company before. Their dividend is over 3. Cardinal Health, it's over 3. Johnson & Johnson, it's just under 3. You've got Pfizer, their dividend is over 3%. And we can go on down the line. And you might be thinking of the last show, well, 3%, hell, that equates a 30-year Treasury bond. Yes, it does. You get bonus points for realizing that, but that's not exactly where I'm going with this, because I'm not really competing with any sort of product or strategy right now. We're competing with yourself. We're competing with the person in the mirror. So here's something that if you're a current client or a prospect, that would be very, very helpful for you to do. And I've told people to do it on other shows. Look at the companies that you own. Think of how long you've owned them. If you've owned them 10 years, then go back 10 years on the computer, maybe 5 years. Look and see what the dividend was some years ago when you owned the company. You can see it on Yahoo Finance, probably Google Finance. Look up the dividend, the dollars or cents per share that you get from that company. Look at what it was 5 years ago. Look at what it is today. Look what it was 10 years ago. Look what it is today. Look what it was 15 years ago. Look what it is today. You're going to be amazed at the growth of dividends for most companies. Even a company as lowly and as boring as Campbell's Soup, their dividend increases kick ass compared to a fixed income investment. But look at those. And unfortunately, the statements that we have nowadays in my industry, they're lacking woefully, because I think the statements should say that. The statements all say the current dividend yield. This is the current dividend that you're getting on the company, and that dividend is based on the current price per share, what it is today. But if you've owned that company for a decade, shouldn't you compare the cash flow that you're getting from the company today compared to what you paid for it a decade ago? That's some real performance. Nobody's statements do that. That's your dividend on your original investment. So if these dividends keep going up every year, that's pretty damn powerful. It's not guaranteed. This is, a couple disclaimers out there, the compliance people that have to okay these shows. When I'm mentioning individual companies, that's not a solicitation to buy or sell. It's for example and discussion purposes only. If you were to go out and buy those companies, I don't know what had happened to you because I don't know you. I have a pretty good idea what the companies will be doing and how they'll be behaving, but again, I don't know you. So these dividend yields that you look at these companies, while they look very attractive compared to the fixed income market right now. Look at what those dividends were 5, 10, 15 years ago. You are going to be astonished, surprised, wondering how this went unnoticed by you. And then if you want to drill down further, call me, have me do it for you, do it yourself, whatever you want to do. Look and see what you paid for that company so many years ago and look at today's income. Don't compare the income from the company to today's price of it. Compare that income to the price you paid in the past for it. That's what you do with real estate. And everybody's god-awful comfortable with real estate. And yeah, if you do that, then you're going to see, it's a rising income stream. Yeah, that's what I've been trying to tell everybody for my whole career. It's a rising income stream that nobody talks about. Okay? And so that's why time in an investment rather than when you invest is so important, because I will get questions from clients, maybe we should invest a little now and a little later and a little later. And it's like, well, I can see why you're thinking that way, but if we invest all now, we get all the dividends from today going forward. And that's one thing that I really want to have happen, because those things tend to be millions of times more consistent than the principal going up and down. Let's get that consistency. Let's get that predictability. let's get that dividend coming to us. Whether it's 2%, whether it's 4%, let's get that sucker coming in. Get that cash flow. You want to rent the house sooner rather than later to get your income. Giddy up. That's what I'm thinking about. So get that dividend income. Now, the dividend income, if it's 2, 3, 4% per year, it's not the magic 10% per year that a person's supposed to be able to earn through owning an index fund or when you take the general stock market. Where does that number come from? Well, dividend is part of it. The stock market over a couple hundred years or more has averaged somewhere around 10% per year. Most people don't know where the 10% came from. Here's where it comes from. The first factor that makes that happen is general inflation. The inflation of the prices of goods and services go up. So if a company's making tires and the rubber gets more expensive, they're going to pass that through to the consumer. And so the consumer pays more. And so just inflation running at 2 to 3% per year in the past, that's where that comes from. Growth of GDP, which means more business being done. Typically, a person that is really good at running one 7-Eleven or one McDonald's, they're going to think about expanding it, improving it, or buying another one. That means doing more business. And that's another 3%. GDP grows at about 3. If you own a good company, they should be able to grow at a hell of a lot more than that, but we'll just use 3. And then, what have I been talking about? Dividends. You get another 2 and 3% from dividends. You've got 3% for inflation, 3% for growth of GDP, and 2 to 3% from dividends. There's your 9% right there. You add in a little bit of halves and quarters there's your magical 10. Okay? That's where it comes from. So everybody talks about GDP. Everybody talks about inflation. Nobody talks about the dividend. Okay? And the dividend is the most consistent part of the equation. And so if we can talk about that dividend and you realize that it's increasing, and then all of a sudden, if it's increasing and you're starting to think, well, is it increasing all the time? I just had you look in that scenario. What was the dividend of whatever company 2 years ago, 5 years ago, 10 years ago, 15 years ago? Now think about what's happened over the last 15 years. Oh, yeah. 2007, 8, and 9. Damn, that was a scorcher to the downside. And if you look at the principal of that company, it went down. Look at the dividend. Unless you're looking at a bank stock or somebody that built homes, the dividend stayed the same or went up. How many people have talked to you about that? No one.
So if I had a company, back then during that, how does that affect the company? Like, do they lose money by trying to give that dividend and keep it up, or is that just...
No, the dividend is declared by the board of directors, which they oversee the management of the company, so they oversee the CEO. They make sure that everybody's doing what they're supposed to do. And then they say, well, the dividend last year was so many cents or dollars and cents per share. What's our profitability this year? Well, our profitability has been normal. So they say, okay, well, if it's been normal, we made more money this year than last year, I think that we should give some of the profits back to the owners. The shareholders is what they're called. And let's increase the dividend. And if it's a normal increase, you're probably talking about a percentage increase in the mid to high single digits. If they had a barn burner of a year and they give you a big dividend increase, well, that's pretty darn skippy awesome. If they had a crappy year or things went bad for them, maybe they had to, like Ford, go through hell and spend a ton of money on doing a new aluminum pickup. Maybe they don't really have that much extra money. Well, they keep the dividend the same. Maybe they only raise it a smidgen because it really wasn't that good of a year, that something happened to take away some of the free cash flow. Maybe they got sued. Maybe they had a bunch of recalls on a car. Maybe if you're dealing with somebody that's growing multiple stores, maybe they spent a lot of money on expanding other stores that year that took some of the profit down. Just normal stuff. Normal stuff that isn't permanent, but it happens. And so when you start thinking about that, this show, guess what? I didn't start you on some anxiety loop like I did the prior show. See how we're thinking more nuts and bolts? That's all I'm trying to get to, is to get you away from the anxiety so that you can more be yourself. And when you're yourself, you can tell yourself, yeah, I'm okay with taking dividends in that individual company scenario that Mike is always yelling about. Or no, I'm still uncomfortable with that. I'd still like a guarantee. Perfect. At least you know yourself now. Or at least you know maybe yourself a little bit better. Why do I always harp on the individual companies and the dividends? Well, because that's where the performance is. Long term, that's where the performance is, and that's where the lower expenses are. If you get to a point to where you realize that volatility is pretty close to meaningless, and you're thinking, how can the prices going up and down be meaningless? Well, they just are. Look at it for a decade, 10, 20 years. If you look at 20, 30 years, you'll have to, the English used will say, well, looks like the downs are temporary and the ups are permanent. You're absolutely correct, sir. That's what's happened. So if that's the case, volatility isn't that meaningful. And once you get to the spot that volatility isn't that meaningful, then you start thinking, well, is volatility all that harmful then? Because I still have people saying that it's a big change when I'm quitting work, and what if I'm taking my income out and it's 2007 started right then, so my principal is going down as well as I'm taking income out. I realize that the dividends are the same or going up, but my principal's going down, and God, I think it's going to feel horrible. And it's like, you're right, it could. That's why I tell clients to keep a year or two income in cash. 2007, 8, and March of 09. That was the worst market that anybody alive right now has lived through. So that was 12, 24, 5, 6, 7, 27, 28 months. If you have 24 months of income in cash, that pretty much gets you through damn near every bit of it. You missed 3 months of it. So that's why I say 2 years. What kind of a bad scenario will 2 years of income not get you through? If you think there is one out there, you are scared. You're not thinking realistically. It's not that you're thinking optimistically enough. What I said isn't optimistic. It's real. That's the way the numbers show, That's the type of bad market that you can encounter. And 2 years of income is going to get you through most of it. That's why I say that. So I realize now, I'm starting to realize that volatility isn't that meaningful. Check. Downs are temporary, ups and are permanent. Check. Volatility could be harmful, but if I have enough cash on the front end, if I've got a year or two worth of income in cash, that should insulate me from bad stuff. Check. Okay. If you're on board, then why would you look for some sort of very expensive product that gave you some sort of guarantee that you don't need and performance-wise you don't want? Because if you will go through that exercise of looking at how much those dividends of companies that you know have been increased over time, then all of the allure of all of these guarantees that everybody shows you, all of a sudden they don't look good to you, let alone the pitiful yield on a 30-year Treasury bond being 3% or a 10-year one being 2.6. That's a crappy deal. And that's risk-free rate of return. A corporate bond paying you, 4 and taking a lot more risk to do that to get 1% more, that doesn't sound very nice. And municipal bonds, those are backed by the taxing power of state and local authorities. Yeah, the state and local authorities have really been known lately to make good fiscal decisions. Said Peppa the Pig. I mean, no. So when you get right down to it, speaking of reality, I'm not that comfortable with that type of stuff. You've been too quiet for too long. Do you need breakfast?
No, I was just
letting you rant.
No place to, yeah. No, I didn't want to jump in.
Did I use up all the time?
Actually, yeah.
bonus.
In fact, you're a couple minutes over, but you were on a rant. I didn't want to interrupt you because you were on a roll.
Well, I'm pretty much done, man.
Okay.
Yeah.
But I'm going to stop you there because now you're insulting cops and I got to drive home. So,
okay. With that was the second of two a little bit shorter shows. One dealing hopefully with the anxiety of income in retirement, and the other one hopefully giving you some tools to deal with that anxiety and income in retirement. And that's pretty much it for this show. Thank you very much for listening. Anything for them, Chris?
just don't forget, go to smartinvestingshow.com. That's got all the links so you can find out, hey, I want to listen on YouTube or I want to listen on this. There's links all over.
Okay, thanks.
And as a reminder, you got to give me some books so I can put on there for people to read.
Will do. We'll be back again next week. Thank you.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.